David, it's always good to be talking to you at the end of or after the end of the month. Over the weekend, we've now got a premium podcast. So I ran a few numbers on this third quarter, 3 months to the end of September, and it really was a volatile quarter, to put it at least. Started off really well in July, but ended really poorly in September. Let's start with the Corion report, which comes out every month on the month of September. How would you describe it?
Well, the month was nothing short of brutal. My colleague said to me, spring sprang and the markets came undone. And the past month saw many markets experience its worst monthly decline since the onset of the pandemic. There was very few places to hide. World equities were down about 10%. The South African market, if you judge the market in terms of dollars, was down 9%, and global bonds were down about 5%. So negative sentiment was far and wide, and cash was unfortunately king. But even there, you had to be in the US dollars. The pound, the euro, the yen, the rand all depreciated substantially against the greenback.
So there was really, if you're in US dollar cash, you're okay, but anywhere else, you got a hiding.
Pretty much everywhere. It's very rare to see such a synchronized sell-off of not only risk assets, but currencies, bonds, gold even sold off. So, if you got a positive statement as an investor come the end of September, you must have done something really special, but I imagine that will be you'll be very much an anomaly.
A bit of an outlier. What about the quarter as a whole? We entered the quarter with lots of hope, or many of us did, thinking that maybe the bear market was over. Well, we know that that's not true. But how do you see those 3 months?
It's been a very difficult 3 consecutive months. The year to date, investors have really felt severe pullback in terms of markets. Going into the year, everyone was concerned that we were at high valuations relative to history. Everyone wasn't aware of what the Fed and the result of historically high inflation would do. And literally, the Fed has thrown the kitchen sink at trying to curb people's spending, get inflation under control. And that has resulted in a very, very difficult 2022.
When we have a look at those big declines in September, NASDAQ down by nearly 11%. Here, as you said earlier, in South Africa, in dollar terms, our market down by 9%. Is it darkest before the dawn time, or are we now entering a really serious bear market?
I think the jury is still out. At Corion, we definitely look at valuations being our guiding principle. From an international perspective, we think, fortunately, valuations are no longer expensive. They're not cheap, but they're reasonably priced. From a South African perspective, though, we see lots of opportunities in the South African market. Local is in our minds lacquer. Our valuations relative to international markets are substantially more attractive. Our bond market is offering very good real returns and much higher yields in international markets. So there's obviously risks in South Africa, but comparing that to the risks overseas, it's not a bad place to be. Is buying into the dip in South African equities, but I probably would guard against buying offshore equities at this stage.
How far do you feel that we might be from the bottom? In other words, from that period of capitulation, the time that the market, people are so disenchanted with stocks that they just don't see a rebound coming, and that's always classically the time that the markets do turn.
Very hard to time that. I think it all really comes down to what the Fed's going to do. That is, over the short term, probably going to be the driver of asset classes around the world. And you're either in the camp that believes that the Fed will do whatever it can to curb inflation with little regard for the broader market fallout. If you in that camp and you're right, well, there's still substantial downside to debt and equity markets. On the flip side, if you believe that it's not long until they have to pause given the economic damage that will inevitably come, well, then the opportunity is certainly to buy. At Corion, we're marginally in the camp that the Fed will do what it needs to do to curb inflation with little regard to the broader fallout. So, as said earlier, we're still reluctant to be in an overweight position to developed markets other than, I would say, South Africa.
Okay, let's look at South Africa. In your video, and I love it, the 1 minute video that you put together, which brings the markets in a nutshell, you point out that load shedding for the year to date in South Africa has been the equivalent of 81 days. Now we're in day 277 for the year, which means about 30% of the days of the year in South Africa, we've had load shedding, which has got to have had a terrible impact across the board, but particularly if in manufacturing businesses, mining businesses, etc. You can't operate when you have been forced to rely on Eskom, which is not delivering the power that you need. So why are you seeing South Africa as a offering potential when you've got something as staggeringly concerning as load shedding going on at the levels that, as you point out, are double those of a year ago?
Look, load shedding is just a catastrophe for the broader economy, the manufacturers, as you said, and we recognize that, and hopefully the government gets a handle on that. It will be a while, but when you break down our market in terms of an investment, to answer your question, you got two big sectors that contribute to your market, being resources and being financials. Financials relative to history, they offer you, look at some of the banks, very high dividend yields, very attractive valuations relative to history. If you look at resources, those valuations, a lot of big basic materials companies are trading at P's of 5 to 6. And that historically is a very, very low entry point. So if you're taking two big parts of your market and you're looking at investing in equities, well, when you've got those two segments at very attractive dividend yields, well capitalized, well, that's the main reason why we are bullish on the local equity market. Sure, there are going to be manufacturers and other players in the industry that are going to feel the brunt of what we are all facing in terms of load shedding, but by and all, putting everything together, those valuations in our mind justify an overweight position to South African equities.
So it's valuations. That's what it's all based on. Not because you think our economy is going to turn around suddenly, and not because our political issues, which really seem to be plumbing new depths every day, are suddenly going to be brighter. It's all about you getting great value.
100%. And it's also that combined with what we're buying in South Africa. We acknowledge that there are segments of the market that are going to be under strain, but the biggest weightings of the South African market are to areas of the market where we think you're getting rewarded for the risks that you have mentioned.
And on the asset allocation, when you're looking at this all in perspective, you've said that you're concerned about offshore markets. You've said that you like South Africa, but what kind of allocations do you have, or would you be recommending right now? Local versus offshore, equities versus cash, etc.
I think it's a very interesting time for asset allocators. In the video that you mentioned, we spoke about and we made a tribute to the passing of Tina. And Tina, over the last 10 years, has been an acronym for there is no alternative. There's no alternative to equities, to risk assets, because bonds were at an all-time low, yielding very little. Cash was yielding next to nothing. So you were forced to go into risk assets. Now you got bond yields in the US at about 4%. That dwarfs the yields you can get in the equity market. And that's a similar picture locally. So it's a very interesting time as an asset allocator because you've got to really diversify, and it's not just a call on equities. But being more specific, where do we think you need to be invested over the next few months? We still think international equities, specifically the US, and we put an article about this in the beginning of the year, is expensive. So we're cautious to be exposed there. We think that bond assets for the first time globally are attractive. If there is going to be a fallout, and if the inflation gets under control, and yielding a 10-year treasury at 4% over the next 10 years, while inflation does get into check, that's an attractive, or certainly a much more attractive asset class as it was to history. So there's lots of things to consider, but from a Corion perspective, underweight international equities, overweight South African equities and bonds, and starting to nibble more and more at international fixed income assets.
When you say underweight, overweight, for a private investor, what is overweight relative to what? In other words, you've got 100 in your portfolio. How much of that would be offshore? How much would be onshore, for instance?
Great question. So we use a term in the industry, and probably incorrectly, because the man on the street probably doesn't understand it, but every client has his unique profile, his unique time period. And when institutions or asset allocators try and build a solution that's best for their needs, they set a target. They go back in history and they say, okay, for a client who has a moderate risk profile, for example, that is investing in over 30 years, the best mix of assets, the best strategic asset allocation for this client over 50 years, given what history has done, given how asset classes are correlated together, is, for example, 50% equities. And that's your guiding start and guiding principle to investing. So, you've got something that over time gets you the best probability to get to your end destination. So when we go overweight, we say, okay, well, we know the neutral is 50, but given where valuations are, they're looking attractive, well, we're going to go to 60%. But if you go to 100%, then you face a real risk that you surprise the client, that client gets a drawdown much more than he's able to tolerate. So it's really setting up a framework for you to deliver a return for a client that is most appropriate for his level of risk.
So it is an individual thing. If you are very young and you've got many years to retirement, you might have a much bigger percentage of equity, in other words, shares, than you would if you were 65 and you needing to now live off your income, and you certainly can't afford, as you say, drawdowns. You can't afford a negative. You can't afford to lose money on your portfolio if you have to start cashing in to live.
100%. Every client needs to know what their risk profile should be and is appropriate for them. When we go overweight or underweight asset class, it is relevant to the risk profile that is best for that client. So if I'm not a financial advisor, and I can't give financial advice, but a financial advisor will sit down with the retail client, try and best ascertain his needs and set the appropriate risk profile for that client. And then it's the job of the asset manager to say, okay, well, that's really the framework and the risk profile that the client needs. I'm going to tilt the portfolio, i.e. go overweight or underweight, relative to that profile and that client's needs.
Oh, nicely put. Thank you, David. Just having a look at your Corion Pure Equity Fund, I had a really good chat with your colleague, Gareth Montano, the other day about this, and he was singing the praises of the asset managers. You've also been singing the praises of Andrew Vincent from Clucas Gray. I see they're doing pretty well in the past year. His fund and the general equity funds in the top 5 there. But how have they been doing during this very, very difficult period, those fund managers that you are relying on for your pure equity fund?
Fortunately, our clients have benefited last month for staying invested. And when I say benefit, we acknowledge we don't operate in a vacuum. When your equity market is down 4% in rands, you're going to be most likely to be down too. So our fund was down. We expected it to be down in that environment, but it wasn't as down as much as the market. So, we had a good September relative to the industry, but that is just a 1 month period. We think we've got something a bit different, a bit unique in terms of how we select managers who select their best ideas. And that kind of approach will be best judged over a 2 to 3 year period, which is also looking great in terms of the investment return. So we think that fund's got quite a lot of roadway, and it's doing what it's supposed to do. So yeah, we are happy that our clients have managed to get the returns that they wished for.
The other part of the Corion report that always appeals to me is the top 40 shares and how they performed, the winners and the losers of the top 40 in that month. And we've had some horrible returns for some big stocks. Capitec down 24% in the month. It lost a quarter of its market cap. Discovery down 15%. Bidcorp 13%. Investec 12%. Process 11%. Those are much higher than the decline of the market overall. So is there a part of you now, the contrarian part of you, that's saying, hang on a minute, these shares have come down too far. It's now time to be piling into those ones in particular rather than the resources shares, which actually did very well and balanced out to, as you say, that 4% decline for the market as a whole?
Corion, we have to take a bit of a longer term view. Yes, we are by nature quite contrarian, but our first starting point is valuations. And as we said earlier, we think the resources bucket or sector is quite attractive. So, we were fortunate to be overweight that sector of the market, and we still think it's cheap. So, given its outperformance last month, and the resources sector was up about 1%, we still think it's got a long way to go. So, we're certainly not selling out of our overweight position resources. Looking at some of the stocks you mentioned that really did poorly, I think some of them were for their own unique reasons. If you look at Capitec, they were down on a trading update. That's a share that's been priced for perfection for a long time. Very good operators, but if you miss your earnings, your revenue targets, and your earnings targets, and you're on a high valuation, and you have a risk backdrop of what we've just had, well, then your share falls a long way. And then you mentioned a few shares that operate in the UK. We all know what's happened in the UK, so that was for its other reasons. So you have a risk backdrop that's pushing everything down, and then you have either misses or specific regional issues, and you add that to the mix, and you get the drawdowns you referred to.
You mentioned the UK. You also mentioned TINA, which was also used by Margaret Thatcher in her era. There is no alternative. We must crush the unions. We must cut spending and so on. When you look at the Maggie Thatcher wannabe Liz Truss in the UK, and she's off to a pretty poor start to her prime ministership there, is it, and given the way that the UK market has reacted and been under such pressure, is it an area that you'd be paying more attention to now than you might have in the past, given that valuations might be appealing?
I think so. There's still, that part of the market, if you look at the UK in terms of its equity market, is very much a lot of big financial firms there. So financial firms are at, as I said earlier, globally are quite attractive valuations. But there are certainly reasons why those valuations are quite low. You've got a government there who's leaning to become more populist. If you have a lot of debt going through the system, aggressive fiscal policy, aggressive monetary policy, well, potentially it all leads to potential higher debt. So there's reasons for the valuations. But I do want to say that I'm going to try and take a positive from what happened in the UK for globally. And then that is when you have this environment where governments are trying to really play to its electorate, and Mr. Market comes in and gives him a bit of a smack. Who would have thought that would have happened in the United Kingdom?
Who indeed? That's David Bacher from Corion, and I'm Alec Hogg from biznews.com.